Welcome back and watching Business Morning on Channels Television. Let's quickly remind you of one of the stories we're tracking here on the program. Nigeria's Attorney General and Minister of Justice, Abubakar Malami, has queried the Central Bank of Nigeria on allegations of disparity in foreign exchange allocations and exchange rates. Now, the financial regulator was accused of arbitrary allotment of foreign exchange at different rates. The Central Bank has denied this, and similar allegations as contained in a statement the regulator issued on January 30 this year. Now, Channels Television is seeking clarifications on this latest query from the officials of the Central Bank of Nigeria, and we expect to have it before the end of this program. And also, just to quickly let you know how the February bond auction went yesterday, the second by the Debt Management Office this year. According to reports out by Vertiva Research, about 45 billion naira was offered on the 5-year bond, 20 billion naira on the 10-year bond, and 45 billion naira on the 20-year bond. So that was how the auction shaped up yesterday. But of course it was oversubscribed. So for the 5-year bond, about 60 billion naira was sold. For the 10-year bond, 30 billion naira, and for the 20-year bond, about 70 billion naira was sold at marginal rates of 16.55, 16.61 and 16.77% respectively. So that segment of the market is looking pretty good, and hopefully investors will be reacting quite positively to these numbers at the end of the day from the trading at the FMDQ OTC Securities Exchange. But we're still talking about the state of the economy and still talking about reactions coming in from yesterday's release by the National Bureau of Statistics, that is the January inflation number, which came in at 18.72 from 18.55% recorded in December 2016. We also had food inflation increasing at a faster pace, even though it slowed month on month, and the core inflation increased 17%, which was, it was 17.9%, lower than 18.1% recorded in December 2016. But let's put this into perspective as we have Gabriel Idahosa, the CEO, UHY Maji & Co., joining us in the studios to take a look at some of the issues. Good morning to you, and thank you for coming in.
Thank you, Harry.
So, taking a look, first of all, at these numbers, did it come as a surprise, especially as it seemed as if most analysts had been expecting maybe a 200 basis points increase, but not as much as we saw yesterday?
Not much of a surprise. We actually expect interest rates to begin to, inflation rates to begin to come down as we progress into the second quarter, because we expect that the food prices should begin to come down as we see agricultural performance improving, harvests coming in. But some of the reasons why the inflation rate is still right there is the fact that we have not managed to improve on the energy side. We are still battling with very high cost of energy. The electricity has not delivered on the promise to improve supply, and therefore both manufacturers and consumers are still spending a lot more on power. In whatever way you consume power and energy, you are still spending a lot more. And for most manufacturers, you are looking at about 30% of the cost of production. So really, it is the failure of power and energy to deliver on the promise coming into this year that we could have a lowering cost of energy. So that's a primary cause. Of course, because our dollar situation has not improved, we are still carrying a lot of inflation from imported inflation from the high cost of foreign currency. So those two main factors that have been driving are continuing to drive inflation. We thought that agriculture could help to bring it down, but it's going to take a longer perspective to do that. Perhaps in the second quarter, you begin to see the inflation tapering once we see the kind of harvest we are expecting.
Mr. Idahosa, I know we've had, I've had conversation with analysts from FTC talking about having bumper harvest, and we've seen that also being reported even by the Ministry of Agriculture. But then Some of the issues and some of the solutions that have been proffered with regards taming inflation are not new issues at all, and they're not new solutions. But it seems as if the more economies proffer the solutions, the more it becomes elusive to attain that which we want, which is taming this steady rising inflation numbers.
Yeah, it's the distance between what you say and what you do. If you say you're going to improve power and reduce the use of expensive options like diesel and petrol to provide power, and you don't really do it, we still have the same issue of falling back on the alternative sources of power rather than the supply from the electricity distribution companies. We still have not been able to ramp up alternative exports apart from oil. The non-oil sector has not grown as fast as we thought it should grow. So the issues are not new. What we just have is the distance between what we need to do to work faster towards self-sufficiency, for example, in food and refined petroleum products. It's taking us quite long, and even the two major refineries that have been built are having issues with foreign exchange to build them.
So is that also your major concern?
It's a major concern, because the hope is that by the end of this year, we should see self-sufficiency in refined petroleum products. We should see self-sufficiency in a couple of food items like rice, perhaps wheat, sugar, 50%. We thought in the middle of last year that will happen. But as we speak, the two major refineries are having issues with funding their projects. And so if we